Welcome to The Big Picture. This is the show where we talk about macro markets and micro market structure. So let's start with David. Why don't you start us off with some macro stuff?
Yeah, I mean, it's felt like a long week, I guess, in the world of macro since we last sat here and spoke. We had, shortly after we recorded last time, we had Powell speak. Markets went on a tear, everything ripped. We were talking about the pivot or the pause, and then bang, on Friday we get a strong non-farm payrolls number, and it kind of just unwound a lot of that. It's followed up by some stronger ISM data, service data. So it's kind of like we're in this kind of push and pull between the markets trying to position for this pivot or pause. A lot of people have issue with me calling it a pivot, but as I think I've said before, like pivot or pause, it's about pricing, changing in the macro regime from pricing this hike cycle to pricing the end of it and the slowdown. And the slowdown's happening, right? We're going to step down from 75 to 50 bips, and then we've only got a few more before then we end. And then we've got to try and think about what we're trading next. But in all truth, like, for all the noise and like Twitter right now is just full of like the world's ending, right? It feels like it a little bit this week with stocks back down, but we've kind of only really unwound the gains post Powell, and us sitting here now, if you hadn't looked at a screen and we're just checking back in, you kind of think nothing's really happened, right? So I don't think much has changed in the world of macro. I also think right now there's a huge amount of noise in the data. So like if I look at non-farm payrolls on Friday, that was a stronger print and everyone's getting excited about that. Or that means that, the Fed are going to have to keep going for longer. At the same time, you have like the household survey data, which actually showed jobs being lost. So there's a lot of like statistical quirks that I guess like leave room to question. Even the ISM data we had the other day that was strong on the official data, but then you had the market services PMI, which was actually showed contraction. So we've got these kind of competing data points. But the one thing I'll try and highlight, I guess, is if we're talking macro here, right, we're trying to talk about trends rather than like being day traders and trying to, and we're up and down the next day. I mean, clearly the big data point now that we're all going to be focused on is CPI next week. And obviously we have the Fed as well. Now, really, if you kind of core macro and we're looking at these macro trends, we shouldn't be so dependent on one data point, right? It should be about the series of data points. But I guess that kind of sums up this kind of skittishness of the market right now, and the fear that, the Fed are going to keep going until they break something. But I kind of stand by the comments that I've sort of made in terms of us being in this sort of macro shift and this change in the macro dynamic as we transition away from this Fed hike cycle to this now to the end of that cycle. The other interesting thing that's really stood out to me as well is, whilst we can debate around what that means for risk, is we've certainly transitioned away from pricing this inflation regime to now it's the recessionary sort of growth fears that the market's sort of really worried about. So it still feels like the inflation's peaks narrative is still there, and people more comfortable with that. Now everyone's worried about growth and what's happening with growth. People are talking once again about 2s, 10s. I mean, that's been inverted for forever, but now it's becoming even more inverted. The Fed's preferred sort of measure for the recession signal, the 3-month, 18-month curve inverted. All the curves are inverted, kind of signaling recession. We kind of have this global slowdown. Oils keeps coming lower, and if we're pricing a growth slowdown versus the sort of inflation fear, then it's a completely different, vastly different implications for assets. And the main takeaway for me is that the sort of big trade for me in that is long duration is going to perform, right? So 10-year yields are coming lower, 30-year yields are coming lower. And that's kind of quite a different regime. Now, how that relates to crypto is a long duration asset, right? So I kind of, if I want to start getting balled up on crypto again, I want to see duration performing, and then I'm going to play crypto as a higher beta duration, long duration asset. So I think this move we're seeing in bonds is really significant. It's also being reinforced by the dollar as well, I think, which is quite interesting, which is coming lower. The one thing at the moment that kind of holds maybe crypto back and risk assets generally is that you then have this kind of risk premium that market's trying to factor in for recession and all this stuff. So risk isn't performing particularly well. But it's a completely different dynamic that we've been in for the last year, where bonds were selling off, equities were selling off, and the world looked a really shit place. I think now we're in this world where actually bonds are rallying on the bad news. Yields are coming lower, and I think that ultimately, continues to put an underlying support to our markets. And as soon as we get a little bit of good news or risk kind of stabilizes, I think that's where you see the kind of higher beta long duration proxies, i.e. NASDAQ and crypto, start to perform. So I still think we're on that trend, and I think it's interesting that we're now transition away from the inflation focus to the growth fear and focus.
David, I saw that you got into this discussion with material scientists on Twitter. Can you sum up his argument and then offer like what your rebuttal?
Yeah, I mean, to be fair, I think saying the same sort of thing in terms of feels like we're pricing this kind of peak inflation, should be good for bonds. I think he's rather than, whereas I'm looking at sort of nominal bonds, I think he's looking at tips and seeing what those inflation proxies are doing as his signal. I think as well he's a little bit more cautious in terms of we're not there yet. But and just seeing the just wait name there, like I think we're but he I think he's picking up on similar things. He's a little bit more concerned about the longer term inflation. So I think he sees this bullwhip effect where we will come off sharply on inflation. But we spoke a little bit around this kind of deglobalization and the potential inflationary impact. A little bit of disagreement, I guess, in terms of I think this reshoring instead of replacing cheap labor from abroad with cheap labor from abroad with people domestically. I think you'll start to see that cheap labor get replaced by robots and technology. So I kind of think technology will act as the disinflationary force and offset some of the globalization or deglobalization. I'm also not so convinced that we're going to see that big deglobalization move. You saw PepsiCo making people redundant this week, and talks that meanwhile they're hiring in India. So I wonder if actually we'll see just a rotation from certain countries where manufacturing and labour is sourced at the moment to other cheaper areas that are maybe less politically sensitive, and then you still got this competition with technology that is going to still replace a lot of manual jobs. So I still think we're in a disinflationary world. Debt, demographics, technology, and those kind of headwinds to inflation for me are bigger, and I think we'll settle back into that kind of Japanified world, as I like to call it.
Yeah.
I think that makes sense. The macro does look a bit more constructive now, but the question is, like, for crypto, like how much does this really matter? Like, I know that David has always talked about crypto pricing from this macro angle, but you kind of look at some structural overhangs as well, crypto specific overhangs that potentially could prevent a continued rally if the macro does improve, right? Like we know, like Bitcoin miners, for example, we know a lot of these guys, like reading the Marathon Digital earnings, right? Like these guys are budgeting from between 16,000 and 22,000, right? Like these Bitcoin miners have liabilities that are denominated in dollars, but their balance sheets are made up of Bitcoin and Bitcoin mining rigs, right? So like, in order to fund these liabilities, I mean, who knows, right? I think there's potentially could be some selling pressure from these Bitcoin maximalists that really haven't budgeted for Bitcoin prices this low. Or I mean, hash rate has definitely taken a step lower as well, but has not come off massively. And then additionally, power costs remain high, right? So I think there's, potential questions around that. And then additionally, sorry.
No, like 100%. And this is what makes these things difficult, right? All those things you say are valid. And actually, if you look at a chart of, say, Bitcoin overlaid with the dollar, with 10-year yields, with even like NASDAQ, it would place Bitcoin around, I don't know, 25,000 right now. So we're obviously kind of feeling the impact from the FTX implosion and the fallout from that. Still a lot of fear around what dead bodies. I mean, the whole sort of Maple story this week and orthogonal, again, it's another sort of element of FUD in the market, and there'll be some real consequences from that in terms of flows and liquidations. So right now it kind of feels the flow dynamic probably still favors, false liquidations. We still don't really know what's happening with Genesis and how that's all going to play out. So you've got a really sort of negative flow dynamic, offsetting what in my mind is a more sort of positive sort of macro dynamic. And probably, once these things kind of play out, and it's hard to tell when, no one knows when that process and that deleveraging process kind of completely runs itself through. Then when it does, then bang, then all of a sudden there's a lot of catch up to play, and that's probably where the money comes in. We spoke about this before. I'm pretty impressed by how well crypto's held up, given what it's going through right now, and given the likely full selling. So there's some decent like accumulation going on, I would say. But the marginal flows at the moment are obviously biased to sellers, and that's the kind of unknown and that we're trying to work out, right? The sort of macro versus that sort of flow dynamic, which, Joe, is why we got you here, right?
Yeah, exactly.
Joe,
so I think this. Go on, Justin. Sorry.
Yeah, to your point, I was just looking up at hash rates. Hash rates have come off significantly, like kind of proving that miners have been forced to shut down a ton of machines lately. But yeah.
Yeah, sorry. But that chart that's only a 1 month chart. Are you able to pull that out?
For sure. No, I not prepared. I just looked up the first thing I could see. Oh, it does have the 1 year. It won't.
Like if you pull that chart off back, you'll see that like the hash rate still is fairly elevated, right? I mean, it's come off a lot in terms of its recent peak. Mm-hmm. But if you just compare it to the level and even beginning of this year, right, it is still quite elevated.
Okay.
But
and the funny thing as well, the one thing I always say, kind of from a macro and even approaching crypto from that macro angle, is like narratives are so important in markets, right? Narratives actually, I think kind of drive everything, and when hash rates were reaching records and crypto was getting hit because of all the other stuff going on, no one even spoke about hash rates. And now all of a sudden, like crypto Twitter and, everyone's talking about hash rates falling and miners collapsing and all this stuff. It's like, well, you didn't get that excited when we were going the other way. But we're in that regime of fear. And everyone's looking at the next thing that could maybe take us lower. But again, that for me is sometimes starts to be the signals when we're near the lows on these things.
Here is the pulled out chart of the hash rate, and you're right, it's pretty elevated since this looks like the COVID crash right there. But
I mean,
this is back June 2021. Yeah, so yeah, it's pretty high still.
Yeah, exactly.
It's come off a ton though.
Hash rate's high. It's come off, but hash rate's high, and input costs for the miners are certainly higher with the cost of power as well, and then obviously the output of the mining process is a lot lower, right? And it's kind of basic math here, right? So and from what we know, right, we talked to all the OTC dealers. It's not like these guys are hedging, right? It's not like it's like Glencore's commodity desk that is basically trading term structure and hedging their exposure all the time. Like these guys don't do that for the majority of them, because they made so much money on the way up. They're all Bitcoin maximalists, but you could get to the point where you potentially need to sell. And I mean, with the hash rate falling, and sure, that presents a decent opportunity to potentially get into the space. But like, especially like, the machines on the market, like I imagine if you need to sell, there's gonna be quite a significant haircut on those.
Yeah. Wait, are you saying that most miners are not hedging?
From the OTC dealers that we speak to, a lot of these guys, trying to have a conversation with them to hedge their exposure, right? Buy, put, sell, collar the exposure. They said it's like slamming their head against the wall.
That's interesting.
Yeah, it's like, I don't know. It's a little bit crazy to me, right? Like, I imagine a commodity producer, like a big, miner, like not hedging the price of the underlying. Like, I don't know. It's insane to me.
But yeah, they kind of set out the top side, right? Like they sell calls, is that right? A lot of these guys.
They'll sell call for the yield enhancement, but I'm more so concerned on the way down, being protected on the way down. Yeah,
but it's a kind of, when you think of that, so they're prepared to kind of give away some of the top side, potentially, and not protect the downside. It's interesting.
Yeah, we should get somebody on the show, that is, has a lot more experience speaking to the miners, because as I think we discussed last week, a lot of the miners don't trade on Paradigm, right? A lot of these guys are doing OTC bilateral transactions, so that could be one for the future.
There's got to be again, maybe something we can look at, but like some kind of like zero cost collar structures or near to zero cost collar structures that kind of protect the downside, and all right, they'll cap the top side for them. Maybe they're the trades that these guys should be looking at. To kind of, they'll give up some of the top side, but if they're doing that in a way, sort of then also protect themselves on the downside.
It's logical. I just don't know if these guys, if they listen.
Do you speak to any of the miners, David or Joe?
No. Yeah.
In the U.S., right? Because these are highly regulated entities, and given their base in the U.S., they cannot trade on Deribit. Yeah. So we kind of avoid all conversations with them. Okay. We do see the flow on the back of it, right? Because they'll do like the yield enhancement, like overwriting strategy with an OTC dealer, and then that OTC dealer will subsequently recycle the risk from that vol selling strategy back onto Paradigm, right? Yeah. So we see the hedging on the back of the miner flow, but we don't actually directly see the miner flow.
Interesting. Okay. Well, speaking about flows, maybe you should launch into what you have prepared for us, Joe.
Yeah. So I think it would be helpful to do a deep dive into the volume trends around crypto options. There's certainly been some misconceptions here, right? A lot of talk around, crypto derivative volumes, they've really trended lower over the course of the year. And sure, maybe that's the case in USD notional terms, which is the y-axis here, right? But how is USD notional calculated, right? That it's the token price times the quantity, right? So it looks like it's trending lower in USD notional terms because the prices of all the tokens have fell. But when you look at the volumes in terms of the number of contracts traded, it's a very different story, right? So this is just an example of a Token Insight Crypto Derivatives report. This was published this week. And if you look at this chart in the vacuum, right, you get this impression that crypto derivative volumes have really died significantly since Q2 2021. But as I just mentioned, it's the decrease in the price of the underlying assets that has been the main reason for the decline in the USD denominated volumes. And this isn't me knocking this report. It's actually a great read. And they do caveat the fact that the price drawdown is the main reason for the decrease in the USD volumes. But now, when you look at the option volumes in contract terms, so this left chart is the Deribit contract volume, and then the right chart is the Paradigm contract volume, right? Like, you'll see that it's only continued to grow, right? Despite this increasing hesitancy to hold funds on centralized exchanges, right? So like in November, Deribit and Paradigm hit all-time highs in volumes. Deribit printed over 10 million contracts, and Paradigm achieved 30% of this market share, right? You see the direction of this arrow. November is this last bar here where it was our all-time highs. So great, but where do the volumes go from here, right? Like one could argue, of course the volumes were higher, right? The second largest exchange in crypto just blew up, and crypto derivative participants are forced to manage their risk with the large spot move, or forced to unwind their existing Deribit positions due to losing funds that are tied up on FTX. And if you look at the daily volumes, so this is basically just Paradigm volumes each day over the past month, right? So if you look at the daily volume since the first week in November, you would see a drop off, right? The volumes trended higher into the FTX blow up, culminating on this day of 50,000 Bitcoin that traded on Paradigm on November 8th, but then it's trended lower the rest of the month, right? So will this trend continue as users sit on the sidelines, or are they eventually going to re-engage this market? And to be honest, I don't have the answer to that question yet, right? Like this bankruptcy has raised like very large unanswered questions around like how much risk is actually being undertaken by institutional players when they trade on native exchanges, right? And I'm sure David can speak to this as well. Like, but we've seen customers like mad dash to digital asset custodians to mitigate this counterparty risk and ensure that exchanges don't rehypothecate assets, right? So like Copper's clear loop is a big one that is continuously coming up on conversations with institutions. And basically what they do is they allow their customers to delegate funds to the exchange, in this case Deribit, without actually moving the assets in an on-chain transaction, right? So like we work closely with these guys, and the market share of Deribit volume that is originating from this Copper clear loop solution now has massively increased over the past 2 months. Like this whole way to mitigate counterparty risk is on the top of everyone's mind when I have conversations with our customers. And when you actually look at the data, right, like the survey data, like it makes sense, right? So this chart here is from Acutity's Crypto Derivative Management Insight Report. So what this report does, it surveys a number of hedge funds, banks, brokers, and asset managers, and it's asked the question, how have the recent events affected where you store your non-invested capital or excess margin? And just as a caveat, so this is actually Q3 data. So this is capturing events like Luna, Three Arrows, lenders like BlockFi going under. It doesn't even capture the FTX. But, the results are fairly staggering, but actually not that surprising, right? So 50%, if you look at this arrow here, so 50% of participants indicate that they have reduced or significantly reduced exposure on native derivative exchanges, while only 25% indicated that they would increase exposure. And again, this is before FTX happened, right? So like since the FTX bankruptcy, we'd expect these percentages to be even higher, right? With more excess funds moving towards, prime brokers and then moving it towards fiat currencies. And we'll certainly, this is an awesome report by Acuity, and when they release their Q4 batch, we'll definitely discuss this on a future episode of the podcast, because I'd be very curious to see what this native derivative exchange and fiat currency response pool will look like, once we have data that captures those events as well. Now, just looking at option markets the past week, and so this is something that one of our big market makers, spoke to, actually Genesis, the lack of trust around the venues, it only hasn't affected crypto option markets from a volume perspective, but it's also affected it from a volatility perspective, right? So like Bitcoin 1 month implied vols are now at 50, right? So this is the bottom of the 3 month range. And we talked about this last week. It's shocking given the potential crypto bankruptcies still looming. And, the conversation I have with clients, I'm like, this is crazy that the vols are this low, right? And then, they're just like, yeah, they're low, but who's going to buy them, right? Who's going to buy them? Like we discussed last week that the buy side taker interest is much lower in the wake of FTX. And there's a much more unwillingness to kind of keep dry powder on these exchanges to take advantage of these opportunities, right? Like I look at this, it looks like a decent opportunity to buy. I mean, granted, the realize has been awful, right? But, it could be, this vol could potentially be quite underpriced, right? Eventually, if some of these skeletons do rise, rise to the surface here.
The other thing I'll chime in to say on that, Joe, as well, is let's not forget the time of year we're in, right? The incentive to take risk, as you're coming towards the end of your year as a fund manager, that they're kind of not there, right? Most people are squaring off the book. If you've had a good year, you're locking it in. If you haven't, that the year's gone, right? And no one's going to give you the limits to come out swinging the bat to try and make something up in the next few weeks. So I kind of feel like even if you're looking at opportunities, you're probably thinking about, let's go in January with those. If you're comfortable with the credit risk and counterparty risks that you're taking on these exchanges. But I kind of feel like, if I'm sat there now managing some money, like the incentives aren't there to sort of go sort of hammering the risk and trying to take advantage of some of this cheap vol that we're seeing.
Yeah, I think that's exactly right. I just think there's a lot of lethargy in the market, and as I said, it could potentially be a good opportunity, despite the fact that realize has come off. But I think I think the problem is a lot of them likely can't add risk or just don't want to add risk into the end of the year and potentially just burn more premium on and just make performance worse. So
do you think you see people starting to add risk in January and vols start to rise then?
Could be the case. It depends on the macro, obviously, and it depends what news we get out between then and now, right? Like if it comes out that DCG is going bankrupt or something, and then the vols absolutely rip and are at the top of the range, then no, people aren't going to buy them. But if they are as low as they are now or even lower, then I would imagine some people are going to be dipping the toe, especially at the start of the new year.
I tend to think, like from my experience in the TradFi world, not to get too boomer on us here, right? But you tend to find, so December tends to be actually quite a busy month, but because people are taking risk down, right, and just closing the books and unwinding the books. I think that process has happened now earlier because of FTX and what have you. And we've seen that, Joe. You spoke to that last week in terms of the flows we've seen. A lot of it's been taking risk off the books, right? So that process has run earlier. I'd say that let's take the risk down. Assess our counterparty risk and make sure we're comfortable with that. And then, so I kind of feel a lot of people have shut the books now. And then January, I do expect January we start to see commitment to risk, fresh positions being put on, and things will look pretty different. That's my expectation.
Yeah, that makes sense. And we've just seen a continuation of that theme this week, right? Like, we've had this drip lower in implied vols, but we're seeing it to kind of just put on, year-end hedges, right? So the biggest one was this Bitcoin December 10,000, 12,000 put spread. So this was bought yesterday in a total of 1,500. I think actually, they could have executed another 200 or 300 lots of this. I think the total size actually might be closer to 2,000. But like, this is kind of just like a year-end hedge. Like, we know the customer, like they've been unwinding a lot of other risk, managing the book into the end of the year, and this is kind of just a sort of hedge for the book in case some news does come out. Just given the drip lower in the implied vols. But then also on the other side, we've also seen unwinds of out-of-the-money spreads, which is suggesting that takers are unwinding risk into the end of the year, right? Like the Ethereum March 1,600, 2,100 call spread, this trade obviously hasn't made any money. June 24, 25s in BTC and then the BTC March 14, 15s, right? So you see a lot of the unwinding of the spreads too, to kind of just, reduce the risk into the end of the year. But a bit of a mixed bag. That's all from me.
Yeah. So I guess, do you guys have any closing thoughts?
Yeah, I think my closing thought is next week's going to be interesting. Inflation report, Fed. I think we're going to see a little bit of action around that. And then I think markets will go pretty quiet. I still think, though, we are seeing this underlying sort of shift in the macro dynamic. And yeah, we might actually see that be exaggerated over the next few months, over the next few weeks in the liquid markets as well. But yeah, strap yourself in. I think it's going to be an interesting week next week, and then I think everyone's going to enjoy Christmas.
Yeah, my final thoughts quite related to that is, as I mentioned, the volumes since FTX have really come down, especially last week. So hopefully we start seeing some of our bigger customers positioning ahead of this CPI event, potentially for some fireworks. Certainly I would like to see it, but who knows?
Yeah. All right. I think that's it for today.